Accounts receivable refer to the outstanding invoices that a company has or the money that clients owe the company. The phrase refers to accounts that a business has the right to receive because it has delivered a product or service. Accounts receivable, or receivables, represent a line of credit extended by a company and normally have terms that require payments due within a relatively short period. It typically ranges from a few days to a fiscal or calendar year. Accounts receivable, AR, are an asset account on the balance sheet that represents money due to a company in the short term. Accounts receivable are created when a company lets a buyer purchase their goods or services on credit. Accounts payable are similar to accounts receivable, but instead of money to be received, they are money owed. The strength of a company's accounts receivable can be analyzed with the accounts receivable turnover ratio or days sales outstanding. A turnover ratio analysis can be completed to have an expectation of when the accounts receivable will actually be received. An example of accounts receivable includes an electric company that bills its clients after the clients received the electricity. The electric company records an account receivable for unpaid invoices as it waits for its customers to pay their bills. A receivable is created any time money is owed to a firm for services rendered or products provided that have not yet been paid. This can be from a sale to a customer on store credit, or a subscription or installment payment that is due after goods or services have been received. Accounts receivable are found on a firm's balance sheet. Because they represent funds owed to the company, they are booked as an asset.